Hey everyone, welcome back to Dollar Dive. On this channel, we cover the biggest financial scandals and money lies. Subscribe for more and let's get into Lehman Brothers. In 2008, Lehman Brothers was rated safer than most banks on earth. 6 months later, it was gone. Not struggling, not downsized, gone. 158 years of history, $600 billion in assets, vanished in a single weekend. The fourth largest investment bank in America filed for bankruptcy on a Monday morning. By that afternoon, the global financial system was on the edge of total collapse. This wasn't a random bank failure. This was the match that nearly burned down the entire world economy. Stock markets crashed, credit markets froze, millions lost their jobs, trillions in wealth evaporated. And it all started with a lie so simple that once you understand it, you'll wonder how anyone fell for it. But here's what makes this story different. Lehman Brothers wasn't run by obvious criminals. They were rated AAA. Pension funds invested billions with them. Governments trusted them with taxpayer money. Wall Street analysts told everyone they were safe, right up until the day they weren't. By the time you finish this video, you'll understand exactly what happened, the accounting trick that hid the truth, the executives who knew and lied anyway, the regulators who had all the warning signs and did nothing, and why the collapse of one bank triggered the worst financial crisis since the Great Depression. But first, we need to understand why everyone trusted Lehman Brothers in the first place. Lehman Brothers was founded in 1850, before the Civil War, before the telephone, before electricity. Three brothers who had immigrated to America started a small trading company in Alabama. They survived the Civil War. They survived world wars. They survived the Great Depression. They survived every financial panic and crisis for over a century and a half. By 2008, Lehman was an American institution. They had offices in every major financial center around the world. They employed over 25,000 people. They had survived longer than almost any other firm on Wall Street. When you've been around for 158 years, people assume you know what you're doing. They assume you're conservative, careful, built to last. This is crucial to understanding what happened. Lehman wasn't some startup tech company taking crazy risks. They were establishment, they were Wall Street royalty. Investment funds didn't question whether Lehman was safe. The question was whether you could afford not to do business with them. This reputation, built over generations, became the perfect cover for what was actually happening inside the firm. Lehman made money the way investment banks do. They helped companies raise money by selling stocks and bonds. They traded securities for their own account. They managed money for wealthy clients. They made loans to hedge funds and other financial firms. These are all normal banking activities. Nothing inherently risky or fraudulent about any of it. But starting in the early 2000s, Lehman got heavily involved in something that would destroy them. Mortgage-backed securities. Here's how they worked. A bank would make thousands of home loans to people buying houses. Then they would bundle those mortgages together and sell them to investors as securities. The investors would get paid as homeowners made their monthly mortgage payments. This process is called securitization. It's not automatically bad. The idea is to spread risk. Instead of one bank holding all the risk of thousands of mortgages, that risk gets distributed to investors around the world. If some people default on their mortgages, the losses are shared by many investors rather than destroying one bank. In theory, this makes the financial system safer, but here's where it went wrong. When banks could immediately sell mortgages to investors, they stopped caring whether borrowers could actually pay the loans back. They just wanted to make as many loans as possible so they could sell them and collect fees. This created terrible incentives, like banks started making loans to people who clearly couldn't afford them. People with no income, no assets, terrible credit, didn't matter. As long as someone would buy the mortgage-backed securities, banks kept making bad loans. Lehman wasn't just buying and selling these mortgage-backed securities. They were creating them. They were making their own mortgage loans through subsidiaries. They were packaging those loans into securities, and they were keeping huge amounts of these securities on their own books rather than selling them all. By 2007, Lehman held over $100 billion worth of these assets. Now here's the problem. These assets were only valuable if homeowners kept paying their mortgages. If home prices kept rising, everything was fine. People could refinance or sell if they got in trouble. But if home prices stopped rising or started falling, the whole system would collapse. People who couldn't really afford their mortgages would default. The securities backed by those mortgages would become worthless, and anyone holding those securities would take massive losses. Lehman's executives understood this risk. They weren't stupid, but they convinced themselves that home prices would keep rising forever. They looked at historical data showing home prices rarely fell nationally. They believed that real estate was fundamentally sound. They thought they were being smart by holding these assets that were generating high returns. They were wrong. In 2006, home prices peaked and started falling. At first, it seemed like a minor correction, but defaults started rising. Subprime borrowers, people with weak credit who should never have gotten loans, started missing payments. The securities backed by these mortgages started losing value. By 2007, it was clear there was a serious problem in the mortgage market. Lehman should have admitted they had a problem. They should have sold these assets, taken their losses, and moved on. Instead, they doubled down. They kept telling investors everything was fine. They kept reporting strong earnings. They kept paying executives massive bonuses. And they started using an accounting trick to hide how bad things really were. This is where we get to the heart of the story, the lie that made everything possible. It's called Repo 105. And once you understand it, you'll see how Lehman fooled everyone for so long. This isn't complicated accounting. This is simple deception dressed up in technical language. Here's how Repo 105 worked. A repo is short for repurchase agreement. It's a common Wall Street transaction where you sell an asset to someone with an agreement to buy it back later at a slightly higher price. It's essentially a short-term loan using the asset as collateral. Banks do these transactions constantly. They're normal and legal. But Lehman found a loophole. Accounting rules say that if you sell an asset and agree to repurchase it, you still have to count it on your balance sheet because you still effectively own it. But there's an exception. If you sell the asset for at least 105% of what you'll pay to buy it back, you can treat it as a sale instead of a loan. You can remove it from your balance sheet temporarily. Lehman used this loophole systematically. Every quarter, right before they had to report their financial condition, they would do tens of billions of dollars of these Repo 105 transactions. They would temporarily sell assets and get cash. This made their balance sheet look better. They looked less leveraged. They looked like they had more cash and fewer assets at risk. Then, after the quarterly report was published, they would buy the assets back. The debt would return, the cash would disappear, everything would go back to how it actually was. But by then, investors had already seen the clean quarterly numbers. They believed Lehman was in good financial shape. The truth was hidden. Let me make this crystal clear with an example. Imagine you owe $100,000 on your credit cards. That looks bad. So right before your annual financial review, you borrow money from a friend, pay off the credit cards, and show your reviewer a clean balance sheet with no credit card debt. The reviewer thinks you're financially responsible. Then the next day you take the credit cards back out, re-borrow the money, and pay your friend back. Your actual financial condition hasn't changed. You just hid the truth at the moment it was being examined. That's Repo 105. Lehman was moving tens of billions of dollars off their books temporarily, just long enough to publish clean numbers, then bringing it all back. This wasn't accounting judgment. This was deliberate deception designed to fool investors about the firm's true financial condition. And here's the thing that makes this so damning. Lehman's own accounting firm thought this was improper. Their American accountants refused to approve Repo 105 transactions. So Lehman found a British law firm that would give them a legal opinion saying it was okay under British law. Then they booked the transactions through their British subsidiary. They literally shopped around for someone who would tell them what they wanted to hear. The amounts involved were staggering. In the fourth quarter of 2007, Lehman used Repo 105 to temporarily move $50 billion off their balance sheet. $50 billion. That's not a rounding error. That's a systematic effort to deceive. And it worked. Analysts looked at Lehman's quarterly reports and saw a bank that looked solid. They didn't know that the numbers were manipulated, but some people suspected something was wrong. They just couldn't prove it. Short sellers, investors who bet against stocks, started targeting Lehman in early 2008. They could see warning signs. Lehman's stock price was falling, credit default swaps, essentially insurance against Lehman defaulting, were getting more expensive. The market was saying something was wrong even if the official numbers looked okay. Lehman executives went on the offensive against these short sellers. They called them manipulators. They suggested they were spreading false rumors. They complained to regulators that short selling should be banned. The CEO went on television and angrily defended the firm. He said people betting against Lehman would lose their money. He projected absolute confidence that everything was fine. Inside the firm, employees were starting to worry. They could see the mortgage assets on the books declining in value. They knew the firm was heavily leveraged. Some raised concerns with management. They were told not to worry. They were told the assets would recover. They were told Lehman had survived for 158 years and would survive this too. One executive inside Lehman tried to raise alarms about Repo 105. He told senior management that the practice was misleading and had to stop. He warned that it could destroy the firm if it became public. His concerns were dismissed. The firm's lawyer said it was legal. The executive said it was necessary to maintain confidence. The warning was ignored. This is a pattern you see in every financial disaster. People inside the firm know something is wrong. They try to raise concerns. They get shut down by people more powerful who don't want to hear bad news. The culture punishes anyone who questions the official story, so people stay quiet, keep their jobs, and hope someone else will fix the problem. Meanwhile, the mortgage market was getting worse. Bear Stearns, another investment bank heavily involved in mortgage securities, nearly collapsed in March 2008. The Federal Reserve arranged for Bear to be sold to another bank to prevent a bankruptcy. This was a warning sign. If Bear Stearns could fail, anyone could fail, including Lehman. But Lehman executives insisted they were different. They said their assets were higher quality. They said they had more capital. They said they were better managed. They told investors to trust them, and many investors wanted to believe. Pension funds had billions invested in Lehman. They couldn't afford to believe Lehman might fail, so they accepted the reassurances and hoped for the best. The credit rating agencies also continued to rate Lehman as safe. These are firms like Moody's and Standard & Poor's that assign ratings to financial institutions. A AAA rating means extremely safe. Investment grade means relatively safe. Junk means risky. Lehman maintained an investment grade rating through most of 2008. This told investors and regulators that Lehman was fundamentally sound, but the rating agencies had their own conflicts of interest. They were paid by the firms they rated. If they downgraded Lehman, Lehman might stop paying them to rate other securities. So the agencies had incentive to keep ratings higher than justified. They also relied heavily on information provided by the firms themselves. If Lehman was hiding problems with Repo 105, the rating agencies wouldn't know. Regulators also missed or ignored warning signs. The Securities and Exchange Commission had examiners stationed inside Lehman. They had access to detailed financial information. They could have investigated whether Repo 105 was being disclosed properly. They apparently didn't. Or if they did, they didn't act on what they found. Years later, investigations would show that regulators had been warned but failed to act. This is one of the most frustrating aspects of the story. It's not that nobody knew there were problems, multiple people knew or suspected. Short sellers were betting billions that Lehman would fail. Whistleblowers inside raised concerns. Credit default swap prices screamed that something was wrong. But the people with power to act, the regulators and rating agencies and Lehman's own board, either didn't see it or didn't want to see it. By summer 2008, the situation was becoming critical. Lehman was running out of time and options. They tried to raise capital by selling new stock. They tried to find a buyer for the whole firm. They tried to sell assets to reduce their leverage. Nothing worked. Investors didn't want to put money into a firm they increasingly suspected was doomed. Potential buyers couldn't get comfortable with Lehman's assets and didn't want to take the risk. In September 2008, everything came to a head. Another large mortgage lender announced huge losses. Financial stocks crashed. Lehman stock fell to single digits. Their credit default swaps were pricing an extreme risk of default. Counterparties, other firms that did business with Lehman, started pulling back. They demanded more collateral for trades. They refused to enter new transactions. This is the death spiral for a financial firm. Once counterparties lose confidence, you can't operate. The Federal Reserve and Treasury Department faced a decision. Should they rescue Lehman like they rescued Bear Stearns, or should they let Lehman fail? They decided to let it fail. The official reason was that Lehman's problems were too big and they didn't have legal authority to bail out an investment bank. The real reason was probably more complex: moral hazard, political pressure, a belief that the market needed to learn that firms could fail. That weekend in September, desperate attempts were made to save Lehman. Bank of America looked at buying them but walked away. A British bank named Barclays tried to work out a deal but couldn't get it done in time. The Federal Reserve convened meetings with Wall Street executives trying to find a solution. Nothing worked. By Sunday night, it was clear Lehman would file for bankruptcy Monday morning. Monday, September 15, 2008, Lehman Brothers filed for bankruptcy. $600 billion in assets, 25,000 employees, 158 years of history, gone. The largest bankruptcy in American history up to that point, and the beginning of the worst financial crisis since the Great Depression. The immediate impact was catastrophic. Stock markets around the world crashed. The Dow Jones fell more than 500 points. Banks stopped lending to each other because nobody knew who else might fail. Credit markets seized up completely. Companies that needed to borrow money for normal operations couldn't. The entire global financial system nearly shut down. But here's what most people don't understand. The problem wasn't just Lehman failing. The problem was what Lehman's failure revealed. If Lehman could be hiding problems with accounting tricks, who else was doing the same? If Lehman could be rated safe and then collapse in days, could you trust any ratings? If regulators missed Lehman's problems, were they missing problems at other firms? The failure destroyed trust in the entire system. Within days, other major firms were on the edge. AIG, a massive insurance company, needed an $85 billion government rescue. Washington Mutual, a huge retail bank, failed. Wachovia Bank had to be sold to prevent collapse. Morgan Stanley and Goldman Sachs, the last major independent investment banks, converted to bank holding companies to get access to Federal Reserve support. The entire investment banking model was collapsing. The government panicked. They realized letting Lehman fail had been a catastrophic mistake. The damage was spreading too fast. They couldn't let more major firms collapse without risking complete system meltdown. So they started bailing out everyone. AIG, the banks, the auto companies, money market funds, essentially anyone big enough that their failure would cause more damage. But the damage was already done. The credit freeze meant businesses couldn't get loans. Companies started laying off workers. Consumer spending collapsed. The economy entered a severe recession. Unemployment eventually hit 10%. Millions of people lost their homes to foreclosure. Trillions in household wealth evaporated. The crisis that started on Wall Street devastated ordinary Americans who had nothing to do with mortgage securities or Repo 105. The human cost is worth understanding. People who had worked hard and saved responsibly saw their retirement accounts cut in half. Families lost homes they'd lived in for years. Young people graduating into the recession faced years of limited opportunities. Small businesses that needed credit to survive went under. The ripple effects touched everyone, all because financial firms took excessive risks and hid the truth. Lehman employees also suffered. Most lost their jobs immediately. Their stock options and deferred compensation became worthless. Their resumes now had a toxic name on them. Many were talented professionals who had nothing to do with the risky decisions. They were just doing their jobs. But they got destroyed along with the executives who caused the problem. The executives who ran Lehman faced minimal consequences. The CEO had made over $400 million in compensation during his time at the firm. He kept most of it. He was never charged with a crime. He testified before Congress and faced angry questions but walked away wealthy. Other executives also kept their fortunes. The system that destroyed millions of ordinary lives barely touched the people responsible. This created a huge anger in the public. Why do bankers get bailed out while regular people lose everything? Why do executives keep their bonuses while employees lose their jobs and savings? Why does nobody go to prison for lies that cause trillions in damage? These questions fueled political movements and changed the conversation about corporate accountability. Some prosecutions did happen. Lower level employees who had committed clear fraud went to jail. But the executives at the top, the ones who set the culture and approved Repo 105, faced civil penalties at most. The Justice Department concluded they couldn't prove criminal intent. The executives could claim they relied on lawyers and accountants who said everything was legal, even though they were clearly hiding the truth. Proving they knew it was criminal was hard. Investigations after the bankruptcy revealed the full extent of the deception. A bankruptcy examiner's report ran thousands of pages. It detailed how Repo 105 was used systematically to mislead investors. It showed that senior executives knew about the practice and approved it. It demonstrated that the firm's accounting was designed to obscure rather than clarify the true financial condition. The report also showed that even before the bankruptcy, there were countless opportunities to come clean. Lehman could have disclosed Repo 105 in their financial statements. They could have stopped using it when their own accountants objected. They could have told investors the full truth about their exposure to mortgage securities. At every decision point, they chose deception over honesty, and ultimately, that destroyed them. Regulations changed after the crisis. The Dodd-Frank Act created new oversight of big banks. Stress tests were required to ensure banks could survive economic shocks. Capital requirements were increased to reduce leverage. These reforms made another Lehman less likely, but they didn't eliminate the fundamental problems of conflicts of interest, regulatory capture, and excessive risk-taking. The rating agencies that failed so badly with Lehman continue to operate with the same basic business model. They're still paid by the firms they rate. The accounting firms that signed off on misleading financial statements still audit the biggest banks. The culture of short-term profits over long-term stability still exists on Wall Street. The incentives that created the crisis weren't fully fixed. 10 years after Lehman failed, studies tried to measure the total cost. Estimates ranged from $10 trillion to $20 trillion in lost economic output. Millions of jobs that were never created, to businesses that never started, homes that were foreclosed, lives that were disrupted. The numbers are so large they become abstract. But behind every number is a person whose life was damaged. Some lessons were learned. Banks hold more capital now. Regulators pay more attention to liquidity risk. Investors are more skeptical of complex financial products. But the fundamental dynamics haven't changed. Banks still have incentive to take risks that generate short-term profits but create long-term danger. Executives still get paid based on results that might be manipulated. Regulators still struggle to keep up with financial innovation. The Lehman collapse proved that there's no such thing as too big to fail. Or rather, if there is such a thing, Lehman was it, and they still failed. The idea that size or history or reputation makes an institution safe is an illusion. All it takes is bad decisions, hidden problems, and a loss of confidence. Then even 158 years of history means nothing. The lie at the heart of Lehman wasn't complex, it was simple. Hide your problems temporarily to look safe. Keep doing it every quarter, ignore warnings, attack critics, pray that the market saves you before the truth comes out. This is the same pattern you see in every financial disaster. The details differ, but the basic story is the same. What makes Lehman particularly tragic is how avoidable it was. If they had admitted problems early and raised capital, they might have survived. If they hadn't used Repo 105 to deceive investors, they might have maintained enough confidence to find a buyer. If regulators had acted on warning signs, they might have forced changes before it was too late. Every step of the way, there were opportunities to prevent disaster. They were all missed or ignored. The aftermath of Lehman showed the interconnectedness of modern finance. When one major firm fails, the effects cascade through the entire system. Counterparties lose money, confidence disappears, credit freezes, the economy contracts. This is why governments end up bailing out firms they know don't deserve it. The alternative is risking total collapse. This creates moral hazard. Banks know they'll probably be rescued, so they take more risks. It's a vicious cycle. Breaking the cycle requires changing incentives. Executives need to face real consequences for reckless decisions, not just losing a job and keeping millions. Real accountability, prison time for fraud, clawbacks of compensation when firms fail, personal liability, until the people making decisions face downside risk proportional to the upside they capture. The behavior won't change. It also requires honest accounting and disclosure. Repo 105 worked because rules allowed temporary window dressing. Those rules should be changed so balance sheets show the actual financial condition at all times, not just on reporting dates. Auditors should be independent of the firms they audit. Rating agencies should be paid by investors, not by issuers. These structural changes would make deception harder. Most importantly, it requires culture change. Too many people in finance see their job as maximizing short-term profits, regardless of risks. They believe if something is legal, it's acceptable. They don't think about whether it's right or whether it might blow up the economy. Until that culture changes, until ethics and long-term thinking matter more than quarterly bonuses, we'll keep seeing crises. The story of Lehman Brothers is ultimately a story about trust and lies. Investors trusted Lehman because of their history and reputation. Lehman betrayed that trust by hiding the truth about their financial condition. When the truth came out, the trust disappeared. And without trust, banks can't operate. The $600 billion in assets wasn't the real loss. The real loss was confidence in the system. That confidence has never fully recovered. People are more cynical about Wall Street. They assume banks are hiding problems. They don't trust ratings or analyst recommendations. They believe the game is rigged. This cynicism is justified based on what happened, but it also makes it harder for the financial system to function properly. Trust is the foundation of finance. Lehman broke it. 15 years later, the name Lehman Brothers is synonymous with financial catastrophe. Business schools teach case studies about their failure. Regulators use them as an example of what to prevent. Economists debate whether letting them fail was the right decision. But for the people who lived through it, the lesson is simpler. Safe doesn't exist. Institutions fail. The system is fragile. Trust but verify. The $600 billion didn't vanish because of bad luck or unforeseeable events. It vanished because people lied. They hid risks. They manipulated numbers. They put short-term profits ahead of long-term stability. They chose bonuses over honesty. And when it all fell apart, they walked away rich while everyone else paid the price. The collapse of Lehman Brothers on September 15, 2008 marked the moment when the financial crisis became a global catastrophe. Before that day, people thought the problem was contained to mortgages and a few troubled banks. After that day, everyone knew the entire system was at risk. That shift from false confidence to real panic happened in hours. The longest-serving investment bank in America disappeared in a weekend. What should you take from this story? First, reputation means nothing when the fundamentals are broken. Lehman had 158 years of history. Didn't matter. They were rated safe by agencies. Didn't matter. Analysts said to trust them. Didn't matter. When confidence is built on lies, it can disappear instantly. Second, complexity hides problems. Repo 105 worked because it was complicated enough that most people didn't understand it. The mortgage securities were so complex that investors couldn't evaluate risk. Whenever you can't understand how something works or how money is made, be skeptical. Complexity is often a feature of fraud, not a bug. Third, incentives drive behavior. Lehman executives were paid based on short-term results. They got bonuses for deals that looked good quarterly but might blow up later. This created overwhelming temptation to hide problems and maintain the illusion of success. Until compensation aligns with long-term outcomes, this pattern will repeat. Fourth, warnings get ignored when listening costs money. Multiple people warned about Lehman's problems. They were dismissed as short sellers trying to manipulate the stock, or as disgruntled employees, or as people who didn't understand the business. The institutional incentive is always to suppress bad news. This is why crises surprise people even when the warning signs were clear. Fifth, there's no such thing as too big to fail. Lehman proved it. If they could collapse, anyone can. Size creates risk, not safety. The bigger the institution, the more damage when it fails. This is the opposite of what most people assume. We think big means stable. Often it just means bigger catastrophe. The lie wasn't that Lehman failed. The lie was that safe ever existed. Safety is an illusion built on trust. When that trust is betrayed through deception, the illusion shatters, and the consequences fall not on the deceivers, but on the people who trusted them. That's the real story of Lehman Brothers. Thanks for watching this deep dive into the collapse that triggered the financial crisis. If you want more stories about the disasters and frauds that shaped our economy, subscribe to the channel. We break down complex financial events into stories you can understand and learn from. Leave a comment about what you think the most important lesson from Lehman is. Thanks for watching, but there's something crucial about that final weekend that shows just how close we came to total collapse. Because while Lehman was failing, other dominoes were already falling. And understanding what happened in those 72 hours reveals why the panic was so extreme. Friday, September 12th, Lehman stock closed at $3.65, down from $60 just 9 months earlier. Executives knew they had one weekend to find a solution or face bankruptcy Monday. The Federal Reserve called an emergency meeting for that night. Every major Wall Street CEO was summoned to the New York Federal Reserve building. The scene was extraordinary. The most powerful people in finance packed into a conference room. The Treasury Secretary was there, the head of the Federal Reserve, the heads of Goldman, Morgan Stanley, Bank of America, Citigroup, everyone who mattered. Their mission was to save Lehman, or at least prevent Lehman's collapse from destroying the entire system. But there was another crisis brewing that same weekend. Merrill Lynch, another major investment bank, was also in trouble. Their stock was falling, counterparties were pulling back. They had similar exposure to mortgage securities. If Lehman failed, Merrill would probably be next. The CEO of Merrill was in those meetings, but he was also quietly negotiating to sell his firm before Monday. Bank of America was the potential buyer everyone hoped would save Lehman. They had the size and resources to absorb Lehman's problems. Executives spent Friday night and all day Saturday examining Lehman's books. They had access to everything, every asset, every liability, every toxic security. What they found horrified them. Lehman's mortgage securities were worth far less than the prices on their books. The firm had been valuing these assets at prices that assumed the market would recover, but Bank of America's analysts ran realistic valuations based on current market conditions. The losses would be tens of billions more than Lehman had admitted. Buying Lehman would potentially destroy Bank of America. By Saturday night, Bank of America walked away from Lehman, but they didn't walk away from the crisis. Instead, they focused on buying Merrill Lynch. This was actually smart. Merrill had problems, but they were more manageable than Lehman's. Bank of America could buy Merrill and become the largest financial services company in America. The deal came together Sunday morning. Merrill Lynch, 94 years old, sold itself to avoid Lehman's fate. Meanwhile, a British bank called Barclays emerged as a potential Lehman buyer. They wanted to expand in America and saw an opportunity. But British regulators refused to approve a deal without government guarantees. They wouldn't let Barclays take on Lehman's risks without the American government promising to cover potential losses. The American government refused. No bailouts. Markets need to learn that firms can fail. This decision would be debated for years. Should the government have guaranteed Lehman's obligations to enable a Barclays purchase? Probably yes. The cost of guaranteeing the deal would have been billions. The cost of letting Lehman fail was trillions. But at the time, officials believed they needed to draw a line. They had saved Bear Stearns in March. If they saved every firm, moral hazard would be enormous. Banks would keep taking crazy risks knowing the government would rescue them. Sunday afternoon, it became clear no deal would happen. Lehman would file bankruptcy Monday morning. The executives gathered in the Federal Reserve building faced a choice: try to contain the damage or let the chips fall. They chose containment. The Federal Reserve announced it would lend money to healthy firms to prevent contagion. They encouraged banks to help each other. They tried to project calm. But Sunday night, another bomb dropped. AIG, the largest insurance company in America, was on the edge of collapse. They had sold billions of dollars of credit default swaps on mortgage securities. These were essentially insurance policies guaranteeing that mortgage bonds wouldn't default. When the mortgages started failing, AIG owed massive payouts. They didn't have the money. They needed $85 billion immediately or they would fail Monday. The government officials who had just decided to let Lehman fail now face an even bigger crisis. AIG wasn't just an insurance company. They had sold credit default swaps to banks around the world. If AIG failed, those banks would take losses that might destroy them. The contagion could be global. Unlike Lehman, they decided AIG was too interconnected to fail. The government arranged an $85 billion rescue package Sunday night. This decision created massive anger. Why save AIG but not Lehman? The answer was timing and interconnection. Lehman's failure was already happening. Stopping it would have required acting earlier. AIG could still be saved, and AIG's tentacles reached into more institutions. But to the public and to Lehman employees, the distinction felt arbitrary and unfair. Monday, September 15, 2008 will be remembered as the day the financial crisis became a catastrophe. Lehman filed bankruptcy at 1:45 a.m. By the time markets opened, panic was setting in. The Dow Jones dropped more than 500 points. Financial stocks crashed, but the real damage was in markets most people never see. The commercial paper market froze. This is where companies borrow money for short-term needs like paying employees and buying supplies. Suddenly, nobody would lend. Companies with perfect credit couldn't borrow money even overnight. This threatened to shut down normal business operations for thousands of firms. Money market funds, which millions of Americans used as safe places to park cash, started losing value. One large fund called the Reserve Fund held Lehman debt. When Lehman failed, the fund's assets fell below the $1 per share that money market funds are supposed to maintain. This caused panic. If money market funds aren't safe, what is? People started pulling money out, creating a run. The London markets faced their own crisis. Lehman had huge operations in London, thousands of employees, billions in assets and obligations. When the American parent company filed bankruptcy, nobody knew what happened to the British subsidiary. Counterparties who had traded with Lehman London didn't know if they would get paid. The uncertainty paralyzed trading. European banks that had lent money to Lehman or had traded with them faced massive losses. Some had exposures large enough to threaten their own survival. Governments across Europe had to step in with guarantees and bailouts. The crisis that started on Wall Street was now global. Asian markets opened Monday night in complete chaos. Stocks plunged, credit markets seized. The panic was feeding on itself. Each new piece of bad news created more fear, which created more bad news. The cycle was accelerating toward complete system failure. Behind the scenes, the Federal Reserve was taking unprecedented action. They opened lending facilities to provide cash to banks. They accepted mortgage securities as collateral that they normally wouldn't touch. They were essentially becoming the lender of last resort to the entire financial system. Without these interventions, dozens of institutions would have failed in the days after Lehman. The Treasury Department realized they needed congressional approval for more dramatic action. They started drafting legislation for a massive bailout fund, $700 billion to buy toxic assets from banks. This became the Troubled Asset Relief Program known as TARP. It would be one of the most controversial government actions in modern history, but getting Congress to approve $700 billion for Wall Street while ordinary Americans were losing jobs and homes was politically toxic. The Treasury Secretary had to literally get on his knees before congressional leaders and beg. He told them the financial system would collapse without action. ATMs would stop working. Companies couldn't make payroll. The economy would shut down. He wasn't exaggerating. Congress initially voted down the bailout. The stock market crashed a record 777 points in a single day. The message was clear: without government action, the markets would destroy themselves. Congress passed a revised bailout bill days later, but the damage from the delay was severe. Let's talk about the specific victims of Lehman's collapse, because the statistics hide real human tragedy. There was a town in Norway that had invested its municipal funds with Lehman. Small town had saved money carefully for years. They put it with Lehman because Lehman was rated safe. The investment was wiped out. The town faced budget crisis. Services had to be cut. This pattern repeated across the world. Pension funds lost billions. These weren't Wall Street speculators. These were retirement funds for teachers, firefighters, and public employees. They had invested with Lehman because their rules required investing only with highly rated firms. Lehman was highly rated until it wasn't. Workers who had contributed to these pensions for decades saw their retirement security damaged or destroyed. Charities and universities lost endowment money. Harvard University lost millions. So did many smaller schools that could afford it far less. These endowments funded scholarships and programs. Students lost opportunities because Lehman failed. Individual investors who held Lehman bonds got pennies on the dollar in the bankruptcy. Some had invested their savings in what they thought were safe bonds from a firm that had survived for over a century. They were wrong. The bonds became worthless. Life savings disappeared. Lehman employees faced immediate catastrophe. 25,000 people lost their jobs overnight. But it was worse than just unemployment. Many had their retirement savings in Lehman stock. That went to zero. They had deferred compensation and stock options that became worthless. Some employees literally lost everything: jobs, savings, future prospects, all gone in one morning. There's famous footage of Lehman employees carrying boxes out of the building that Monday. Some are crying, some look shell-shocked. They're not just leaving a job, they're leaving the wreckage of their entire financial lives. And most of them had nothing to do with the risky decisions that destroyed the firm. They were accountants, assistants, researchers, innocent casualties of executive failures. The bankruptcy process revealed the complexity of Lehman's global operations. They had subsidiaries in dozens of countries, each subject to different laws. Untangling which entities owed what to whom took years and cost hundreds of millions in legal fees. Creditors fought over scraps. Some countries' laws gave their creditors priority, others didn't. It was financial chaos. The bankruptcy administrators found that Lehman's record keeping was deliberately obscure. Assets weren't clearly categorized, transactions weren't fully documented. This wasn't accidental, it was designed to make oversight difficult. When regulators or auditors asked questions, Lehman could point to complexity and claim nobody could really understand it all. This complexity became a weapon used against creditors trying to recover money. One particularly cruel aspect was that different Lehman subsidiaries had different fates. The American entity filed bankruptcy, but some international subsidiaries were solvent and could have continued operating. However, because they were all under the Lehman name, counterparties wouldn't deal with them. Panic destroyed value that could have been preserved if the Lehman name hadn't become synonymous with failure. The failure also revealed the danger of prime brokerage. Lehman provided services to thousands of hedge funds. They held hedge fund assets. They financed hedge fund trades. When Lehman failed, those hedge funds couldn't access their own money. Assets were frozen in bankruptcy. Hedge funds that had nothing to do with mortgages and hadn't taken bad risks were suddenly unable to operate. Some failed purely because their assets were trapped in Lehman's bankruptcy. Let's examine why nobody went to prison. This question haunted the aftermath. Prosecutors investigated for years. They found extensive evidence of misleading statements and deceptive practices, but they concluded they couldn't prove criminal intent beyond reasonable doubt. The executives could claim they believed the valuations. They could say lawyers approved repo 105. They could argue they were optimistic, not fraudulent. The legal standard for fraud is high. You have to prove someone knowingly made false statements with intent to deceive. In complex financial situations, proving knowledge and intent is very difficult. Executives have lawyers and accountants who give opinions. They can claim they relied on professionals. Even if those opinions were wrong, relying on them isn't necessarily criminal. Civil penalties were easier. The Securities and Exchange Commission charged executives with misleading investors. Some paid fines and were banned from serving as executives or directors, but these penalties were small compared to the compensation they'd earned. The CEO paid a fine smaller than 1 year of his bonuses. He kept hundreds of millions. This didn't feel like justice to most people. The failure to prosecute Lehman executives contributed to public anger about the crisis. There was a sense that the system was rigged. Executives gamble with other people's money. When they win, they keep millions in bonuses. When they lose, taxpayers bail out the system and executives face minimal consequences. This perception of unfairness fueled political movements like Occupy Wall Street and the Tea Party. Comparisons to the Bear Stearns rescue became inevitable. Why save Bear in March but let Lehman fail in September? The answer wasn't purely financial, it was also political. After Bear Stearns, there was outrage about Wall Street getting bailed out. Politicians and pundits said moral hazard was terrible. The government felt pressure to show that firms could fail. Lehman became the example. In retrospect, this was a catastrophic miscalculation. The 6 months between Bear and Lehman also mattered. When Bear was rescued, many believed the crisis was contained to a few firms with too much mortgage exposure. By September, it was clear the problem was systemic. Every major financial institution had questionable assets and high leverage. If the government saved everyone, the cost would be enormous. They drew a line at Lehman. The line didn't hold. Days later, they were rescuing AIG than everyone else. The Federal Reserve's actions after Lehman were extraordinary. They cut interest rates nearly to zero. They created lending programs with names nobody had heard before. They started buying mortgage securities directly to support the market. They coordinated with foreign central banks to provide dollar funding globally. These were desperate measures, some were of questionable legality, but they prevented complete collapse. The housing market continued its free fall. Home prices fell 30% nationally from peak to trough. Some markets fell 50%. Millions of families faced foreclosure. Neighborhoods were devastated by empty homes and falling values. The wealth effect of falling home prices reduced consumer spending, which killed jobs, which caused more foreclosures. Another vicious cycle. Unemployment rose from about 5% before the crisis to 10% at the peak. Millions lost jobs. Many were out of work for months or years. Long-term unemployment created skill gaps and despair. Some people never recovered financially. They took early retirement or dropped out of the labor force. Their lifetime earnings were permanently reduced. The crisis revealed how interconnected global finance had become. Problems in American subprime mortgages brought down banks in Iceland, Ireland, and Spain. Countries that had seemed financially stable faced sovereign debt crises. The idea that you could invest globally to diversify risk was proven false. When a crisis is big enough, everything goes down together. Iceland was particularly affected. Their banks had borrowed heavily in international markets and invested in risky assets. When Lehman failed and credit markets froze, Iceland's banks couldn't refinance their debts. All three major banks failed in a single week. The country's currency collapsed. They needed an international bailout. A functioning, developed economy nearly went bankrupt. Ireland guaranteed all bank debts to prevent panic. This was a mistake. The bank debts were larger than the entire Irish economy. When the banks failed anyway, the government bailout nearly bankrupted the country. Unemployment soared. Young people emigrated. A generation was damaged, all because banks made bets they couldn't cover and governments tried to protect them. Spain's economy was heavily dependent on construction and real estate. They had their own housing bubble. When global credit markets seized after Lehman, Spanish construction collapsed. Unemployment hit 25%. Youth unemployment hit 50%. Imagine half of young people unable to find work. The social and political damage lasted a decade. The crisis also destroyed faith in financial models and risk management. Banks had sophisticated computer models that said their risks were manageable. Lehman's model said they were safe. Every bank's risk models failed at once because they all made the same assumptions. They assumed housing prices wouldn't fall nationally. They assumed markets would remain liquid. They assumed correlations between assets would stay normal. All wrong. This revealed a fundamental problem with financial risk management. Models are based on historical data. They work fine in normal times, but crises are by definition abnormal. The events that would destroy your bank don't appear in historical data because if they happen frequently, banks would already account for them. Models create false confidence that encourages excessive risk-taking. Lehman's risk managers had warned executives about concentrations in mortgages. They were told not to worry. The model said it was fine. Senior executives believed what they wanted to believe. This pattern repeated across Wall Street. Risk managers are supposed to constrain risk-taking, but when they report to executives who profit from risk, their warnings get ignored. The rating agencies faced particularly harsh criticism. They had rated Lehman investment grade days before bankruptcy. They had rated mortgage securities as safe when they were actually toxic. Their failure was complete. Congressional hearings revealed they had known the ratings were questionable but issued them anyway to keep issuers happy. The agencies defended themselves by saying ratings were just opinions, not guarantees. Investors shouldn't rely solely on ratings, but investors had to rely on them because regulations required it. Pension funds legally had to invest based on ratings. Money market funds had to hold only highly rated securities. The system forced institutional investors to trust ratings that proved worthless. Reform of rating agencies was attempted but largely failed. The fundamental conflict of interest remains. Issuers pay for ratings. If an agency gives tough ratings, issuers go to competitors. The business model encourages inflated ratings. Proposals to have investors pay for ratings or to randomly assign agencies have gone nowhere. The same agencies with the same conflicts still rate securities today. 10 years after Lehman failed, studies examined the lasting damage. Economic output was permanently lower. Instead of growing at 3% annually as before the crisis, growth stayed around 2%. This difference compounds over years. The economy in 2018 was trillions of dollars smaller than it would have been without the crisis. That gap represents jobs not created, businesses not started, wealth not generated. Workers who entered the job market during the crisis never caught up. Their starting salaries were lower. Their career progression was slower. Studies showed they would earn less over their entire careers compared to people who graduated just a few years earlier. Through no fault of their own, their lifetime earnings were reduced by hundreds of thousands of dollars. The political consequences were enormous. The crisis created or amplified populist movements. People were angry at elites who created the crisis and then got bailed out. Trust in institutions collapsed. This contributed to political polarization and the rise of anti-establishment candidates. You can draw a direct line from Lehman's failure to political upheaval that followed. The crisis also revealed that the financial system had grown too large and complex for anyone to truly control. Regulators couldn't understand the risk banks were taking. Bank executives didn't understand risk in their own institutions. Risk models failed, rating agencies failed, auditors failed. Every layer of oversight and control failed at once. This suggests the system has become too complicated to be safe. When no individual can comprehend the whole, when risks are too complex to measure, when interconnections are too numerous to track, catastrophic failure becomes inevitable. You can add regulations and supervisors, but you can't fix a system that exceeds human capacity to understand. Some argue we should break up banks to reduce complexity and interconnection. Others say complexity is inherent in modern finance and we need to accept it. The debate continues, but what's clear is that Lehman's failure showed the current system is fragile. We came very close to total collapse. Only massive government intervention prevented it. That won't necessarily work next time. The parallels to the Great Depression are instructive. In 1929, a stock market crash triggered banking panics. Banks failed, credit disappeared, the economy collapsed, unemployment hit 25%. It took World War II spending to fully recover. We came terrifyingly close to repeating this in 2008. Only the lessons learned from the Depression about the need for aggressive government action prevented it. But we've forgotten some of those lessons. The financial system has grown as concentrated and risky as before 2008. Too big to fail, banks are bigger now. Trading is more complex. Leverage is lower than 2008 but still high. By historical standards, the ingredients for another crisis exist. We just don't know what will trigger it or when. What's certain is that the Lehman collapse of September 15, 2008 was a turning point. Before that day, people believed the crisis was manageable. After, they knew the system was broken. Before, there was false confidence. After, there was justified panic. That transition from illusion to reality, from lies to truth, happened in a single day. The 600 billion in assets was just a number. The real loss was the illusion of safety. Thanks for watching this comprehensive examination of Lehman Brothers and the crisis it triggered. Subscribe for more deep dives into financial disasters and the lessons they teach. We break down the most important business stories of our time. Leave a comment about what aspect of Lehman's failure shocked you most. Thanks for watching.